Securing the right financial resources is one of the most critical steps in turning an entrepreneurial vision into a sustainable reality. Without sufficient funding, even the most innovative business ideas may struggle to get off the ground. However, navigating the world of financial resources can be complex, requiring careful planning, thorough research, and strategic decision-making. This module, Finding the Right Financial Resources, from the Financial Planning for Entrepreneurs, Build Your Dream course, provides valuable insights into identifying, evaluating, and securing the financial resources necessary to achieve business success. Why financial resources matter. Financial resources are the backbone of any business. They are necessary for 1. Startup costs, covering initial expenses like registering the business, purchasing equipment, or building a product prototype. 2. Operational costs, funding day-to-day operations, such as payroll, inventory, and utilities. 3. Expansion plans, scaling the business, entering new markets, or launching new products. 4. Managing risks, building a financial cushion to address unexpected challenges or market fluctuations. Choosing the right financial resources ensures that a business can operate efficiently while minimizing debt and maximizing returns. Types of financial resources. Entrepreneurs have access to a wide range of financial resources, each with its advantages and limitations. Understanding these options helps in making informed decisions. 1. Personal savings. Many entrepreneurs start their businesses by using personal savings, which may include 1. Savings accounts. 2. Retirement funds. 3. Liquidated assets, such as stocks or property advantages. 1. No repayment obligation or interest. 2. Full control over the business without external interference. Limitations. 1. High personal risk if the business fails. 2. May limit the ability to cover larger expenses. 2. Friends and family. Borrowing money from friends or family is a common way to finance a business. This informal funding is often based on trust and personal relationships. Advantages. 1. Flexible repayment terms. 2. Minimal or no interest charges. Limitations. 1. Constrain relationships if the business fails or payments are delayed. 2. Lack of formal agreements may lead to misunderstandings. 3. Bank loans. Traditional bank loans provide a structured and formalized way to secure funding. Loans can be short-term or long-term, depending on the business's needs. Advantages. 1. Large funding amounts are available. 2. Fixed repayment schedules offer predictability. Limitations. 1. Requires strong credit history and collateral. 2. Interest rates and fees can be significant. 4. Angel investors. Angel investors are individuals who provide funding in exchange for equity in the business. They often invest in startups with high growth potential. Advantages. 1. Access to significant capital. 2. Investors often bring valuable industry expertise and mentorship. Limitations. 1. Entrepreneurs must give up partial ownership. 2. Investors may influence business decisions. 5. Venture capital. Venture capital, VC, firms invest in businesses with high growth potential, often in exchange for equity. They focus on scaling the business quickly. Advantages. 1. Access to large amounts of funding. 2. Professional guidance from experienced investors. Limitations. 1. Stringent selection process. 2. Loss of significant ownership and control. 6. Crowdfunding. Crowdfunding platforms like Kickstarter, Indiegogo, and GoFundMe allow entrepreneurs to raise money from a large number of individuals, often in exchange for rewards or early access to products. Advantages. 1. No repayment obligation for reward-based crowdfunding. 2. Builds a loyal customer base early. Limitations. 1. Requires a compelling campaign to attract backers. 2. Success is not guaranteed, as funding goals may not be met. 7. Government grants and subsidies. Many governments provide grants, subsidies, or low-interest loans to support small businesses, innovation, and economic development. Advantages. 1. Free or low-cost funding with no equity dilution. 2. Supports industries like technology, healthcare, and sustainability. Limitations. 1. Highly competitive application process. 2. Limited funding amounts and specific eligibility criteria. 8. Bootstrapping. Bootstrapping involves running a business with minimal external funding by reinvesting profits back into the business. Advantages. 1. Full control over the business. 2. No repayment or interest obligations. Limitations. 1. Growth may be slower due to limited resources. 2. Requires strict financial discipline. How to choose the right financial resource. Selecting the right financial resource depends on the following factors. High-growth businesses may benefit from venture capital, while small, stable businesses might prefer personal savings or loans. Startups often rely on personal savings, angel investors, or crowdfunding, while established businesses can explore loans or equity funding. For small amounts, personal savings or friends and family may suffice. Larger amounts may require bank loans or VC funding. Entrepreneurs must assess how much financial risk they are willing to take and whether they are comfortable sharing ownership. Short-term needs can be met with loans or crowdfunding, while long-term needs may require equity funding or grants. Ensure that the chosen financial resource supports the business's vision and growth strategy. Best practices for securing financial resources. A well-structured business plan helps convince investors, lenders, or backers of the business's potential. Explore all funding options to identify the best fit for your business. Create realistic revenue and expense forecasts to demonstrate the business's viability. Networking with investors, industry leaders, and financial institutions can open doors to funding opportunities. Be open to combining multiple funding sources to meet your needs. Finding the right financial resources is an essential step in achieving entrepreneurial success. By understanding the different types of funding available, such as personal savings, loans, angel investors, and crowdfunding, entrepreneurs can select the option that aligns best with their business goals and risk tolerance. The Financial Planning for Entrepreneurs, Build Your Dream course equips participants with the knowledge and tools to identify, evaluate, and secure the financial resources they need. With careful planning and strategic decision-making, entrepreneurs can build a solid financial foundation to turn their dreams into reality.